Did you catch that little tremor in the Indonesian stock market back on March 18th? It was uh, enough to make investors keeping an eye on Bursa Malaysia, Magu, wonder if that volatility might spill over.
Yeah, it's fascinating right off the bat, isn't it, how interconnected these regional markets seem to be. Something happens in one place, and immediately people start asking questions elsewhere.
Okay, so let's really dig into this. For this deep dive, we've got this transcript from Triando on YouTube. Our goal here is to sort of unpack what happened with the Indonesian market volatility and also get a handle on this buy now, pay later BNPL trend that seems to be really, well, picking up speed in Malaysia.
Right, so we're looking at two kind of sides of the regional economic picture. A sudden market shift, and then this rapid change in consumer credit.
Exactly. The video hits both. First, that dip in Indonesia, and then it pivots to BNPL in Malaysia. So let's start with Indonesia. The video mentions a report from Singapore's Shin Min Daily News.
Ah, yes, that report. It highlighted a pretty significant single-day drop, didn't it? Even called it the largest in, over a decade. Led to a trading halt, which always gets your attention.
It does sound dramatic, but the video host makes a really good point, I think. While that single-day percentage drop was big, saying largest in over a decade might be, well, slightly misleading if you don't add context. He reminds us that, during the COVID pandemic, the overall index actually fell quite a bit more substantially.
That's a crucial distinction. Headlines grab you, but you need to remember previous shocks and their scale. Context is everything.
Absolutely. The video also touched on those early rumors, something about the Indonesian finance minister resigning, though apparently that was quickly denied. But it seems the more fundamental reasons were maybe deeper worries about the Indonesian economy itself.
Precisely. Things like concerns about weaker consumer spending, maybe some financial difficulties popping up in certain sectors that can make investors nervous, and, well, that can trigger foreign capital outflow. It's a pretty classic dynamic, especially in emerging markets.
And the video points to a couple of specific companies that really dragged down the Jakarta Composite Index, the JSX. Two names mentioned were DCA Indonesia, that data center operator, which saw a huge 20% drop, and also Bank Rakyat Indonesia.
Yeah, those are heavy hitters in the Indonesian market, so their movements definitely make waves. But the story behind DCI Indonesia's drop is, well, quite something.
Oh, it is. This is where it gets really interesting. The video highlights that just in the month before this drop, like between mid-February and mid-March, DCI Indonesia's stock price had just gone absolutely nuts.
Yes, that's right.
It surged from around 46,000 Indonesian rupiah to over 226,000. That's more than 5 times higher in just a month?
Yeah.
It really makes you wonder what was behind that kind of frenzy.
Exactly, that kind of explosive upward move. Right. It often screams speculative trading, which can be super volatile and, frankly, not sustainable. A surge like that often sets the stage for, a sharp correction.
Right. So that recent fall was very likely, a correction after this crazy speculative run. It kind of puts the 20% drop in perspective when you see the massive climb right before it.
And when you have those rapid price swings, especially if people have borrowed money to buy in, leveraged positions, the risk of margin calls and forced selling goes way up.
Right.
Basically, the price drops sharply. The lender says, you need more money. That's the margin call. If the investor can't provide it, the lender might just sell their shares automatically for selling, and that just pushes the price down even further. It can snowball.
The video even compares it to that Black Monday in the Japanese market last August, just showing how a sudden jolt in one place can send ripples,
Useful comparison, yeah. Market sentiment can be pretty contagious. Investors react to big events elsewhere, even if the direct economic ties aren't immediately obvious.
Now, the big question some might have is, okay, is this like a rerun of the 1997-98 Asian financial crisis? But the video host is quite clear that there are key differences.
And this is really critical. I mean, yes, 97-98 saw huge amounts of foreign capital flee the region. But the landscape now is different, partly because, China emerged as this massive investment destination after 2000. That's fundamentally changed capital flows in Southeast Asia.
Right, and the countries themselves, Malaysia, Thailand, others, they learned some tough lessons back then. They built up these really substantial foreign exchange reserves as a cushion. Malaysia's reserves, around, 100 billion US dollars. That's a direct result of being more cautious, including that decision not to fully re-internationalize the ringgit.
Exactly. That proactive shoring up of defenses makes these economies, much more resilient to outside pressure than they were back in the late 90s.
Stepping back for a wider view, It's actually pretty amazing to see the Jakarta Composite Index's growth over the last 20 years. From around 500 points to over 7,000 now, that's more than a tenfold increase.
That's huge growth. It
Yeah.
really reflects Indonesia's economic journey and the growing investor confidence over that time.
Now, compare that to Malaysia's KLCI. It's hovering around 1,500 points now. If you look back 20 years, adjusting for index rebasing and stuff, technical adjustments they make, it was maybe in the 500, 600 range on the old basis. So percentage-wise, the growth looks smaller in Malaysia. But as the video points out, Indonesia started from a much lower base after the 97-98 crisis, and its market was just smaller back then.
Exactly. A lower starting point naturally allows for more dramatic percentage gains as an economy catches up and its market matures.
And Indonesia's really strong growth in the last decade or so, it's put down to a few key things. Economic reforms, being successful at attracting foreign investment, and just the sheer size of its domestic market. Over 200 million people. The video even calls it a kind of mini China in terms of benefiting from reforms. That huge internal market provides a really strong foundation.
That's a great comparison. That large domestic market acts like a powerful engine, giving it some insulation from global ups and downs.
So the sort of reassuring takeaway here seems to be that this recent Indonesian dip probably isn't going to trigger a major crash in Malaysia. The KLCI has been more conservative, its valuation is relatively low. That acts as a bit of a buffer. Plus, Singapore's market has actually been doing pretty well lately. It shows how different markets in the region can perform differently.
Absolutely. Each market really has its own story, its own drivers and challenges.
It really does. The video points out how Malaysia's KLCI has been a bit, well, stuck around that 1,500 level for over 10 years now. And Thailand's in a similar boat, only got back to pre-97 levels around 2015 and then kind of stalled. Political instability gets mentioned as maybe holding Thailand back. It makes you wonder what Malaysia needs to really kickstart growth again, doesn't it?
Yeah, these long periods of stagnation really highlight the need for maybe new structural reforms or new growth engines to attract investment and boost confidence.
Definitely. The video stresses that need for new growth drivers, new component stocks to liven things up, and it mentions the government is working on that. Okay, let's switch gears now. While we've seen some stock market jitters, there's this other huge shift happening in consumer finance, the explosion of buy now, pay later in Malaysia.
Ah, yes, BNPL. It's a really fascinating and very rapid transformation we're seeing.
The video cites a pretty stunning statistic from the second finance minister. BNPL transactions hit RM 7.1 billion in just the second half of 2024 alone. That number just jumps out at you, showing the speed and scale this thing is reaching.
That is a substantial figure. It really speaks volumes about how popular BNPL has become in a relatively short time.
And it is still pretty recent, isn't it? The video notes that BNPL options really only started popping up prominently on platforms like Grab, Shopee, Lazada, maybe in the couple of years after the pandemic hit. The convenience, especially for buying online, just seems to have clicked with people.
Well, the ease of use, spreading payments out, no immediate big hit to the wallet. It's clearly an attractive proposition for a lot of shoppers, particularly online.
Now, there's a flip side, a concern. Could this BNPL boom actually hurt traditional lenders? Finance companies like Aeon Credit, RCE Capital, their stock prices apparently dipped back in January and February this year. That kind of market reaction suggests investors are thinking, maybe borrowing habits are changing, maybe there's more competition coming.
That's a logical worry. If a big chunk of consumer credit starts flowing through BNPL instead of traditional channels, it could definitely put pressure on the growth, maybe even the profits, of those established lenders.
And a key issue here, potentially a big one, is that people could be racking up debt with these BNPL schemes, but it might not show up on their normal credit reports.
Exactly.
So someone could get overextended without anyone having the full picture. That lack of visibility is a risk, right, for the individuals and maybe even for the wider financial system down the line.
Absolutely. If BNPL debts aren't factored into credit checks, it creates this kind of blind spot. Lenders can't accurately gauge someone's real risk, and consumers might take on more debt than they can really handle.
That's where the government seems to be stepping in. The video mentions the Consumer Credit Bill. It's been tabled in Parliament, passed its first reading on March 4th, apparently. The idea is to beef up consumer protection in the credit world. This bill feels like a really important move to kind of update the rules for these new ways people are borrowing.
Yeah, that legislation is crucial. You need the rules to keep pace with financial innovation, and you need to make sure consumers are properly protected in this changing landscape.
And significantly, the bill aims to actually include BNPL obligations in people's credit scores. So Using BNPL will start to impact your ability to get other loans, car loans, personal loans, mortgages. Lenders will get a fuller picture.
That integration into the established credit reporting system is key. It gives that holistic view of someone's debt load and should, hopefully, mitigate some of the risks of people getting in over their heads with BNPL.
The video also throws out some interesting stats about who's using BNPL in Malaysia as of December 2024. 5.1 million active users, mostly aged 21 to 45, with monthly incomes under RM 5,000, spread across 12 different providers. Those demographics suggest it's really appealing to maybe younger people and those with tighter budgets.
Those numbers do suggest BNPL is filling a particular gap or meeting a specific demand within those groups.
What's also quite interesting is the total outstanding BNPL debt, RM 2.8 billion. Now, that sounds like a lot of money, but it's currently only about 0.2% of Malaysia's total household debt. So percentage-wise, it's still pretty small.
Right, relatively small for now.
But as you said earlier, it's the growth that's significant.
Exactly. While the slice of the pie is small today, the rapid growth suggests BNPL could become a much bigger piece of household debt down the road if this trend keeps up.
Totally. This BNPL market is expanding fast, and it looks like a potentially huge untapped credit market. The video makes this really interesting comparison, draws a parallel to the growth of the civil servant loan market, which apparently really fueled the growth of companies like RCE Capital back in the day. That's quite insightful. These niche credit markets can just explode sometimes.
It's a great point. It shows how specific segments can suddenly take off and create totally new opportunities or reshape existing players in the financial sector.
Which makes you wonder, could we see actual dedicated BNPL companies become major players, maybe even get listed on the Stock Exchange eventually? Or will it be the existing listed companies, the ones with BNPL arms, that see a big boost from this? The potential for BNPL to become a really distinct sector to watch in the market seems, well, pretty real.
It definitely has the feel of a market that's evolving quickly, potentially creating new investment angles and shaking up parts of the financial services industry.
It really does sound like BNPL could be the next hot sector for investors. The video even mentions the host plans to share ideas about specific BNPL-related stocks with paid subscribers later, which just underlines that growing investor interest.
Yeah, that signals the investment community is definitely noticing the potential here.
So just to wrap things up then, on the one hand, we had the Indonesian stock market drop. Looks like it was significant for a day, but probably more of a correction after some wild speculation. And maybe not a huge immediate threat to Malaysia because the markets are a bit different and Malaysia's position is stable.
Right, different dynamics at play.
And on the other hand, you've got this BNPL market in Malaysia just booming, growing incredibly fast. Now it's attracting regulatory attention to protect consumers and make sure the debt gets properly tracked. And this whole BNPL space, it looks like it could become a really substantial part of Malaysia's credit landscape.
Yeah, two quite different developments, a market correction and a rapidly growing credit trend. But both give us these really valuable insights into the dynamic economy of Southeast Asia right now.
And that kind of leaves us with this thought, doesn't it? Given how quickly people are adopting BNPL and its potential to grow maybe tenfold or more even within the current debt landscape, what are the bigger, longer-term effects going to be on how people manage their money, on the whole financial services industry in Malaysia? And crucially, can the regulators find that sweet spot, encouraging innovation, but also stopping widespread debt problems before they start, especially as this market gets bigger and more mature? Definitely something to mull over.